Hey everyone, welcome to the KE Report, a daily editorial where we're going to be covering the moves in the precious metals, much more bullish environment than we have seen just in the last couple trading days. But overall, you got to take into account just how well precious metals have done this year and the recent correction. About 3 weeks of downward movement, 3 to 4 weeks of downward movement, and then 3 weeks of sideways movement, and now a bit more momentum to the upside. We are going to cover it all with Dave Erfle, founder and editor of the Junior Miner Junky. Click the link in the show notes to visit Dave's website. Dave, what's your takeaway from, again, that correction that we had in the metals that lasted, 3 to 4 weeks, the sideways consolidation, and now a lot more life in gold, silver, GDX, GDXJ, SIL? Everything seems to be moving together higher now.
Yeah, very bullish. The gold's got all the wind at its sails again. Geopolitical and macroeconomic. And as far as the gold price is concerned, we had that 54% move of almost $1,000 in a year, and we hadn't corrected as much as 5% in all that time. It got really extreme overbought coming into the U.S. election. And, all that uncertainty was lifted when the Republicans had a clean sweep, and gold did a quick 10% correction and created a bullish symmetrical triangle above its sharply rising 18-week moving average. That's been strong support for over a year, and came down and tested it. And I talked about it last week in my article, that the probability of it breaking out to the upside with all the wind that it's at gold's back again. And sure enough, the gold price today February gold closed over 2750, and silver closed above 3250. We talked about last week how it was likely going to break out to the upside because of what the SIL was doing, showing relative strength to the gold stocks, and the GDXJ was showing relative strength to GDX. So that was anticipating a breakout to the upside in the symmetrical triangle here. And the CPI inflation came in today. It was, inflation's continuing to go up. The Fed's obviously caved on inflation. It's not going to come anywhere near their 2% target. And even though that looks like that's going to be the case, they're continuing to talk that they're going to lower interest rates. And Canada lowered interest rates another 50 basis points today. The Swiss National Bank and the ECB are expected to lower another 25 basis points tomorrow. And the inflation came in higher, and it's 95% priced in now that the Fed's going to lower another 25 basis points. So they've caved on inflation. Gold sniffing that out. The geopolitical situation around the world is getting much worse. France and Germany, I mean, they don't even know who's going to be leading the two largest economies in the Eurozone. In Syria, there's a mess over there. I mean, that a toppled 13-year Assad regime's been toppled. We still got a Ukraine-Russia situation going on. There's a calm in the storm over there, thankfully. But gold's got all the wind at its back now going into the end of the year. And it looks to me like that $3,000 target that I've been talking about happening in Q1 of next year, it looks like it's on track. We still need to see a weekly close above 2750 this week and above 3250 in silver. The gold silver ratio is getting close to 80. I'd like to see it below 80 to be more encouraged on this rally continuing, but it's sure looking good going into the end of the year, and basically the Fed lowering rates again next week.
Yeah, Dave, you're right. There's really a flurry of different tailwinds at the back of the precious metal sector right now. Everything from monetary policy to central bank buying. China also came out and mentioned it was back buying again in the market as another factor. You've seen strong buying in India from gold and silver, and then all of the other factors that you laid out. Now, if you think back just a couple of months ago, back in October, when things were peaking out, when we were talking back then, and gold was up to 2,800 and silver was up to 35, everybody at the time was noting it was getting overbought and that it had really run a really long distance really quickly. If you think about this year, it's been a stellar year. Everybody knew it had to correct. Then it corrected for, as we mentioned, about 6 weeks, and everybody fell apart sentiment-wise. Now, we all knew it was going to happen. We all knew it had to correct. Then it did, and people like, lost their minds over it. Isn't this something that we see almost every year at this time of year, Dave? We see the tax loss selling, and then coming out of the end of the year, we see a seasonal spike into the beginning of the next year. I mean, what do you make of it as someone that's followed these markets for decades?
It is, yeah, and people panicked even more because the gold stocks really didn't provide that two times leverage that they normally provide, right? It's we see gold and the GDX up about the same this year. So GDX is still trading where it was when gold was below $2,000 an ounce. So that's a big reason why a lot of people panic. But yeah, I mean, it's a bull market. And like I said in the past, whenever there's corrections, they're short and sharp. They come down to test moving averages and then it goes right back up again. But, the silver is what is really looking bullish to me here. We talked about that rounded bottom at $30 last week and the SIL showing relative strength. It's trading at its 52-week high here, and GDX is nowhere near its 52-week high because we have both, Barrick and Newmont, who's make up 20% of the GDX. They're still showing, yeah, a relative weakness to the GDX on those higher costs that are coming out. Now Molly wanting to put Mark Bristow in jail. So I'd still like to see the GDX. If we see the GDX make a quarterly and yearly close above 40 here in a couple weeks, that would be really bullish going into next year for the mining sector.
So, Dave, just one note. I'm seeing SIL still a little bit off of its 52-week high from October, but again, a much better chart than GDX and GDXJ in terms of a shallower correction and even quicker rebound. It does look like, look, these stocks are set up well, and silver has been doing well. When it comes to maybe the gold stocks, have you seen any sort of leadership, any sector of stocks or types of stocks that have been outperforming either during that correction or now during this new leg higher?
Yeah, I mean, you've seen the mid tiers do better than the majors. Like I said, mostly because of Barrick and Newmont really disappointing on their costs in their last quarter. It really hit them hard. Agnico Eagle, still basically the best miner on the planet. They're still trading at 52-week highs. And Wheaton Precious Metals, one of the best royalty plays out there, it's still trading at 52-week highs. So, yeah, I mean, there's still a lot of mid tiers and some smaller cap growth oriented producers that are outperforming and bifurcating from the sector. It's still a stock picker's market. I mean, retail is still nowhere near this sector. So it's still a stock picker's market. You have to be in the best stocks.
Well, to that point, Dave, you're someone that builds a portfolio and shares that with your subscribers over at Junior Miner Junky. And when you're building your portfolio, you're trying to pick those outperformers. A lot of the people we've talked to this year that have been stock pickers with that rifle approach have actually done a lot better than what you would see if you look at, an ETF, for example. So, what would you say to people trying to construct their own portfolios as to the ways to be a better stock picker?
Yeah, I still see the developers as basically the sweet spot here, especially silver developers. I got a couple of silver developers in my top 10 that are doing really, really well. And I've got three in the top 10 that are late stage developers that are fully financed, that are bifurcating and doing really, really well. So, you have to concentrate on these developers with multi-million ounces. They're late stage. They've got really solid management teams with that access to capital. And they're either fully financed, close to being fully financed, close to being fully permitted. That's another key. There's some of them that they're close to the finance stage, but they're still a year or two away from being fully permitted. Some of those have been lagging, although I have one in my portfolio, one of my top 10 today that's up over 10%, and the stock and the chart looks really good. So some of them are starting to catch up now, and that's what we want to see. We've got this is basically pretty much the last week of tax loss sellings. It usually wraps up the second week of December. Sure, you're going to have some more next week, but most of it wraps up this week. And you want to take a look at some of these stocks. If you see a large volume in a stock and it looks like it's reversed this week, that's probably tax loss selling wrapping up in that stock. And if it's got all those bullish fundamentals that I just talked about and they're trading at a depressed price, that and it looks good going forward for their economic studies and their cash, and they're fully funded for next year, that's something you might want to start nibbling on here on, before we go into the end of the year.
So, Dave, what do you consider fully funded or close to being fully funded? Obviously, fully funded means that they have enough cash that they've already raised that covers CapEx plus, let's say, 10-ish% on top of that. But what does close to funded mean to you?
Well, if you're talking about a developer that is in the finance stage and they've just raised enough money to cover the initial capex plus the overage into production, that's what I consider fully funded. But if you're talking, if you're talking about an earlier stage developer going into 25, you want to see that they're fully funded for next year, their budget on what they need to accomplish. If they're going to be issuing a definitive feasibility study or a pre-feasibility study, are they fully funded into that?
Dave, what's your preference or what's your take on the disparity between late stage explorers that are advanced, that have a resource out, maybe they've got a PEA out, so they're kind of that early stage developer, that are still aggressively drilling? They're trying to get catalysts, they're trying to like move the needle with exploration or maybe a new discovery or looking at a new area, versus those that have kind of a bank of ounces in the ground already. They aren't really doing much, and they're kind of doing the orphan work, that stage of the Lassonde curve where they're doing the permitting and they're doing the studies and they're doing the metallurgical work. Do you think that one area has been shunned more than the other, where there's more upside, either in the optionality of a company that already has defined ounces and is de-risking, or the one that is spending money hoping to build value but could also be blowing money? Which one do you like more?
Oh, absolutely. The latter. The companies that are in this orphan period, they've got all these ounces in the ground. They've done the work. They've proved up, a solid resource, and they're just working on permitting now. And maybe they don't have the access to capital that they need to go forward. Those are the ones that are trading at, $5, $6 an ounce in the ground. They're just looking for that partner that they need to go forward. But I like the companies that have that access to capital and they're close to being fully permitted and they're fully financed for next year, and maybe they're even fully financed into construction, and they're about to make a construction decision, or they've made a construction decision. Those are the companies that are going to really do well next year.
Well, and those ones at least have the more clarity on near-term catalysts, right? Because some of these other assets and companies that have a defined resource, but they're looking for a partner, there's no telling when a partner could come in or even if a partner is going to come in. How long would you sit in one of those stocks that, look, the valuation seems like it should be higher because of the resource, but again, they don't have that partner. They don't have that capital in the door. How long will you wait?
Yeah, that's a great question. I've got a couple of them right now that I'm down 40, 50% on, that I'm waiting on, that are in that situation. But the management teams, I have a lot of faith in the management teams. Maybe it's a couple of them that are management teams that have made me money in the past on other projects, other companies, and they have that access to capital. They have a strategic partner, but their share count's getting up there, and the dilution is starting to lower the upside in their stock. But if I still see the stock is going to at least have a double from what I paid for it, and when I originally bought into it, I saw 3 times upside or more. But now the dilution and the sector being so bearish has brought the stock price down lower and the share count higher. It's lowered that upside. But if I still see, at least the stock making a double, I'm going to hold on to it. I didn't sell it for tax loss. So, it's a fine line, and it also depends on, how far out the project is to being fully permitted. Is the management team, especially the CEO, are they buying shares in the open market at these levels? And the ones I'm holding, they are. So I like to see that. So, as long as they have the access to capital, they're a proven management team, they're serially successful. They've got partners that can act, they have partners to access funding. They just need time to do the work and complete the process. And we're waiting for basically for retail to come back into this sector and help these share prices along as well.
Well, Dave, let's talk about the other side of it. Rather than the buying and the holding, when is it appropriate to sell a position in the portfolio? Since we are in the season of tax loss selling, maybe some people have some stocks they're holding that don't have all the ingredients you just laid out. Maybe there's a long wait for a permit, or there's not a lot of catalysts that are evident for next year, and they're down 40%, 50% in a position. Should some people consider, if there's not a lot of catalysts, not a lot of reasons to move forward, cutting their loss in one and putting that capital to work in one that has more catalyst? Or there's a double-edged sword here, because they could also do that and then maybe a strategic comes in the very next week and they miss the pop. So how do you balance out when to sell a stock that's languishing to get into a better name versus when you stay the course?
Yeah, there's a rub, right? I mean, you have to take all those things into consideration. Look, this is going to be dead money for a while. You talk to management, you see where they are and what their expectations are, and you see that they're not getting close to getting a partner. They're getting low on funds. They're not fully funded until next year. If they've got cash of that it's only going to keep them going for the next 6 months or so, then you definitely want to think about selling it for tax loss and getting into something else. And you should have been thinking about that several weeks ago. So yeah, I mean, it is definitely a fine line. There's something I sold recently that I finally gave up on the stock because the company built a mine. They mismanaged capital markets a couple times, and they had to issue a bunch of warrants. I looked at the share price it was at now. I looked at what I paid for it, and I looked at all the warrants that were basically low, could be exercised lower than my cost. And I said to myself, okay, this is something I have to sell because it looks like this company is going to even need even more money, and they're going to be forced to dilute at an even more depressed share price than they did the last two times.
Yeah, the never-ending cycle for some of these companies. Look, if the stock's not performing, yes, you can always try to buy those ones that are scraping the bottom, and maybe they will get revalued with just again strong bull market. But Dave, this doesn't seem like the same type of bull markets that we've had in the past for this sector. When you consider that most of this year, ever since March, it's been a very good environment for precious metals. And quite frankly, gold is almost tripled in price over the last 9 years. It hasn't been the same move in the stocks, especially in the juniors, from past bull market cycles. So, is there something different going on here? Do we simply need to stick to the quality stocks and not play that game where you're trying to bottom fish some of these lower quality names simply because you think this rising tide is going to lift all boats?
Oh yeah, absolutely. I mean, it's still a stock picker's market. I mean, retail left basically 12 years ago, and they have yet to return. They're still being distracted by AI, by crypto. You just look at the volumes; they're still really low. And I've said this before: there's no dumb money in the sector to bail you out of your mistakes anymore. In the past, we always figured, okay, we got tax loss selling coming up. It's a great time to sell our losers and start buying some things in the middle of December that we can get really cheap. But that's not worked the past couple of years because we've started off the year after with more of a downswing. So, until we have the retail coming back into this sector and bidding up some of these stocks that are so depressed, they've got the goods, they got the ounces in the ground, but they're lacking the catalyst that we talked about. Then it's going to remain a stock picker's market, and you have to be very sure. You have to do your due diligence. You've got lots of time to do it, to do your due diligence and get into the right stocks. You want to be buying and holding the right ones going into 2025.
It's true. Something you and I even talked about at Beaver Creek too. Stick to the higher quality companies. And you know what? Maybe this is just a different type of cycle. There has been, in a way, a lost generation of investors for this sector. And what I keep hearing, it's the more sophisticated investor that's here, which I think is true, which is why we continue to see the best projects get funded and a lot of these other languishing juniors continue to struggle to raise money. Maybe it all changes. Maybe we do go back to those true bull market environments that we've seen in past cycles. Or maybe we just need to understand that you just need to stick to quality and don't get distracted by some of the lesser quality companies out there. Dave will wrap it up here. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Click that link in the show notes to follow along with Dave and what stocks he is trading. Dave, thanks for your time. Have a great rest of your week.
Always a pleasure, guys. Thanks. You too.